All right, all right. Good evening, traders. Good to see everybody. I realized I'm like, wait, did I send it out? I couldn't remember if I had. So hopefully, via email, via Discord, the link made its way. Obviously, you're here. I guess I'll find out tomorrow morning from everybody else if I gave enough notice. But okay, we're gonna give it just a minute. Good to see you, Stephen. Will we hear from Gary? Okay, so I think so, but I'm actually also going to introduce Glenn, the G's, Glenn and Gary. Probably on one of the Tuesdays or Thursdays. I had provided him some info to review to be ready. So yeah, let's hope so. Because I'm sure you guys are like, yeah, we kind of get tired of hearing from you, Scott. I get it. I get it. Just don't say it out loud and I'll be fine. Hopefully you see my screen. Welcome out to the Market Watch Group Options Foundations 2.0. We need a new theme song for this. We're doing 2 months instead of one. So instead of 8 sessions, we get 16 or 17, I think we get over the next 2 months. We're covering the same information. It's not like there's 6 strategies that I just didn't have a chance to show you. So if you had a chance to look through, watch, attend the first in December when we did the options December, the same concepts. We're going to talk about the fundamentals of options, the definitions, key terminology, the characteristics, make sure you're comfortable reading an options chain, things like that, right? When we get into strategies, I don't believe that we need 18 different strategies and people always trying to come up with their next strategy, right? Options are cheap. I like buying them. Pretty simple, right? If I think it's going to be more time, then I might do some kind of a time spread. The longer I'm in the trade, the more likely I am to consider a time oriented, not necessarily a time spread, right? But some kind of a trade that has a time based element. We are going to cover the Greeks, that is theta. So I think we need to understand how to buy options. I think we need to understand the basics of spreads. So we talk about vertical spreads, bull call, bull put, bear call, bear put. I think you should have non-directional trades in your arsenal. That's going to be your butterflies, your calendars, your iron condors. And I think you should have the ability to build combinations where it's kind of a mix of a strategy. That might be your diagonals, your broken wing butterflies. That's it. I could show you by illustrating the Greek profile, delta, theta, vega. At any given time, I'm going to need to know those 3. We're just going to start with that. I might even have it on my slide. I don't know. Delta, theta, vega. Price, time, volatility. That's it. We can build from those strategies what we need to build and construct. And it will give you more, let's just say, for example, as we get to April and hit May and June, there's a lot of sideways in the summers. And if we have that, and you rely on directional trading, it's going to be frustrating. But if we have the ability to diversify, not by stock to stock, because I think we all know by now, you're not really, I mean, there's some diversification, right? We don't like to over correlate trades in groups and sectors, but I believe diversification by strategy is much more effective, where I'm like, hey, you know what? If I have a directional trade and a non-directional trade, if it goes up, I could adjust the non-directional trade. If it goes down, I can stop out of the directional. I'm making money on the non-directional, and great, I'm in a good place. So the ability to really balance things out. It's going to be exciting. 2 months. I'm very excited. Tuesdays and Thursdays, every night. Tonight, we start with intro to options. Here are the disclaimers. As always, education, illustrative purposes. We are not advisors. We are not brokers. We will talk about trades. Interestingly enough, last year when we did in December, we had calendars. We put a couple of on and they crushed. They were really good trades. I don't know if anyone's continued doing any calendar spreads. It's been a great environment, low volatility, good environment for calendar spreads. What else? Did I finish this? Yeah, those are the disclaimers. Agenda. We're going to talk about the Options Foundation's course agenda, right? We're going to talk about the types of strategies that we're going to see. So you're going to see what we have in front of us, but we're going to have more time to stop and build trades, show you how to explore them in the pricing model. So it's going to be a little bit of theory, and then we'll get to follow up with application, theory, application, theory, application. If you have any feedback from last time, any ways we can improve ongoing, let me know. But here's what we're going to be doing. So we're going to talk about understanding derivatives. We're going to talk about why should we want to trade options? Oh, I could have an entire session just listing the ways I love options. We're going to talk about the basics of options. We're going to talk about getting access to a pricing model. Sandy, I want an update. What have you found out from Interactive Brokers about any option? I swear I Googled it one time as I was thinking about it, but tell me if I'm wrong. But what do they have by way of option pricing model, theoretical options, anything like that? If you can find it, then you can start to, dive in. Those of you stateside, I use Thinkorswim. I think Thinkorswim, this is not a recommendation. I'm going to tell you my opinion on Thinkorswim. And I have a strong one because, full disclosure, way back when I worked for Thinkorswim when Thinkorswim was its own company, when it merged with an education company that I worked for. This is back in like 2006. But I've been with them ever since. And now Charles Schwab owns them. They made really sure to let everybody know that Thinkorswim would still be around. Why? Because if you trade options, you love the platform. Great charts, great option analytical capabilities, great order types. It's all in one place. So if you're wondering as we're going through this, or if you're listening to the recording, what platform are you on, Scott? Thinkorswim. And you can keep asking and I'll keep telling. But that's going to be an important part of this, because every trade I want to see theoretically before I actually place the trade, whether I'm trading on paper or if I'm trading live, I'm still going to build that trade. It's an interesting thing. And when I pull up the platform here in a little bit, I'll show you, but you have a paper trading. Paper trading is an entire platform that allows you to practice in a live, real-time environment that is really, really close to real trading. Really, really close. Phenomenal job of it. That's paper trading. Now, sometimes people will say the term simulated trading, and I want you to be careful, because simulated trading is what we're going to do in the option pricing model. It's not a paper trade. A paper trade is I place it. It shows me profit or loss. I can set stops. I can set all the different types of orders that I can set. I can play with them. It's a real platform. That's paper trading. Simulated trading is let's build the trade in an option pricing model so that we can see what are the risks and the rewards at various intervals. How does this trade behave relative to price shifts, time shifts, volatility shifts? So we have to be clear between paper trade, that's practicing in a real environment, but it's demo, versus simulated trade. Simulated trade is we are building, whether you're live or on paper, we're always going to simulate the trade first. Let's build it. Let's look at it. Let's put our stop, our target, our time frame. What's our risk? What's our reward? How long do we have before this thing starts to concern us? The more we can forward look proactively at how this trade might behave according to 3, 4, 5 different potential scenarios, the better equipped we're going to be to trade it. Hello, Leonard Jones. Good to see you, sir. Glad you can make it. you didn't miss anything. We're still talking about the agenda, so welcome. And then we'll summarize. Okay, so here's what we're going to do for the entire course. Instead of this being Tuesday, Thursday, Tuesday, Thursday, Tuesday, Thursday, Tuesday, Thursday, which was a lot. I think we got in the weeds. We would all agree, if you were there, it's hard to touch on this. I wanted to touch on all of this, and I wasn't sure. I wasn't sure what it would be like. I think we all still benefited from it, but now it's going to be, session application. There may be a little bit of play somewhere in there, but that's what I'm looking at. So today, intro to options. We might hit these first two in the first week, and then this on next Tuesday we'll continue with basic option strategies, and then we'll be on a Thursday education, Tuesday application, kind of a leapfrog, and then that'll give us one or two bonuses at the end. I think that's what I'm going to do with that, but we'll see. Here's what we're talking about: intro to options, all the foundational stuff that I can remember. I can remember so many different things, trading options, where people would mention something. It's hard now, but it might be the simplest of things where someone's talking about strike or premium or triple witching or delta neutral, or right. There's all these little things you'll hear someone throw it out and you're like, I'm not quite sure what that means. There's a lot of moving parts. There's a lot of strategies. The way that I want to go through this is building blocks. We want to go through all the components first. The first thing we're doing here, we're turning the pieces over of the puzzle, making sure we're oriented, get our corners in place. We're kind of have a sense of what we have going on, right? And then we're going to start building into it one piece at a time, building on prior concepts. There's a very specific logical flow of how we're going through these in their structure and organization in the order that we're going to cover. So key concepts, terminology, basic option strategies. What is basic options? Buying calls, buying puts, right? Buying calls, buying puts. Now, if you're new, you might be like, I don't even know what a call or a put is. Great. We're going to talk about key concepts, talk about terminology, talk about intros, all of that. Once we talk about buying them, what's the logical next step? Some people think spread. No. First you buy them, then you sell them, then you combine them. So we talk about buying first. We talk about it because there's a very specific perspective. Most of the time when we're talking options, we're going to talk about it from the perspective of a buyer, an option buyer. And so, rights, what can I do? That's from a buyer. If I was a seller, it's the opposite. Now rights become obligations, right? And so the perspective it's important that we make sure we understand that. So we'll start with buying, then we'll move to selling, then we'll start to combine. That's option spreads. We'll do credit first, then we'll move into debit. Those are both vertical. They are interchangeable. If you ever hear someone say, oh, credit's better because, you can stop listening. One's not better than the other. Whatever somebody builds as a credit spread, I could build a debit spread that looks exactly like it mathematically, meaning delta, theta, vega, how it behaves. It's not better or worse. They're different, and what might make them appealing is different. So vertical is these first two. Then we start to move into time spread. So vertical means we're still wanting the stock to go up or the stock to go down, vertical, up and down. Then we move into, well, wait a second. What if we become agnostic to the direction of price because we're much more concerned with time? You have three core variables in options: price, time, volatility. Price, up and down, fluctuation. Volatility, inversely correlated, up and down. Time always ticks, and it always ticks at a consistent rate. So time is the most consistent variable in options. Therefore, if I can have it in my favor, I'm going to. Now, people are like, well, then shouldn't you always sell? No, I don't like selling cheap things. If volatility is low and options are cheap and I'm in the market for 5 to 9 days, I will have a better trade as a buyer. It's empirical, and I can mathematically establish that. So, yeah, but it's important for us to know when we do which strategy and why. So that's the time spreads. Then we move into advanced combination strategies. What is that? That's when we start getting 3 legs. That's your butterfly, broken wing butterfly spreads. And then we get to 4 legs. That's your condor, iron condor trades. And then we will wrap it up with and here's the thing. We've already mentioned Delta Theta Vega, right? We've already mentioned it. So I'm going to be priming that every step of the way. And then we're going to really tie it together, because you can't start with the Greeks and implied volatility. It won't make sense. So we basically just have to kind of expose you a little at a time to them. And then we're going to come in with the big punch and really say, like, okay, how is implied volatility going to be a part of every options trade that you consider? What role will it play? What am I going to do with the Greeks? People often say, well, why don't you ever look at the Greeks on the options chain? The options chain is before. That's what I'm looking at before I get into the trade. I don't care what the options are before, at least not from the chain. If I care about the options before, I care about them as a composite, meaning multiply it by 100 so that it's representative of a contract, not just one share. And then I need to know whether it's positive or negative, and then I need to multiply it by the number of contracts. That's what the options pricing model does. The options pricing model is going to be taking into consideration the delta, the theta, the vega. How much does it lose in time? So how much would we lose 10 days from now or 14 days from now? It's essentially a great big what if that allows us to see every aspect of the trade before we place it. So we can be like, yeah, this makes sense. I like this. Let's move forward. Okay, let's hit it. Tonight's agenda. Existing resources. What are the existing resources that we have? Let me dive in there here real quickly and show you your existing resources, because we do have them. In your content library, if you scroll down, and I need to put 2.0 in, but actually we didn't do options in our Trading Foundations 2.0. But last time we did Trading Foundations, we actually did a nice couple of intro to options. So if you're like, I want to know and understand calls and puts and rights and obligations and assignment and exercising and how many shares per contract and when's expiration and how do all these things that you just like, that's part of the intro. So there's 2 videos here. There's a good amount of content there. Then if you look, this is our last foundations. And we tended to go over our time every time. I think we were closer to an hour on most of these, but you have everything we're going to do now. You can go through and at least get an intro, but now we're going to be able to go through in more detail, more time. And it always makes more sense when you're looking at options relative to current market conditions. So this is what's available to you now. Remember, you also have available to you the options trading log. That's here in the welcome doc. The options trading log, if you're going to be doing some options trading, that's what you have. Okay. Let me know if you have any. It's quiet out there today. Everyone feeling all right? Everyone feeling good? Existing resources. Understanding financial derivatives. Give me a check-in now and then, just so I know everyone's still conscious. And yes, Stephen, that one will be updated as well. Thank you, Leonard. Okay, exploring the what are we going to be doing? We're going to be looking at the foundational concepts of derivatives. So that's an important first concept to understand, because you hear that you're like, derivative of what? Derivative, the derivative is of the stock. So people always say, should I learn to trade stocks or options first? Stocks, 100%. You have to. everything I do on the option is based on my analysis of the stock. When I do like non-directional delta neutral trades, meaning calendars, condors, things like that, I don't do them on individual stocks. I do them on ETFs, the market, SPY, IWM, QQQ, DIA. I tend to either be directional on a stock or I don't want to trade that stock. If I'm non-directional, I'd rather just do it on the broad market as a whole. So just keep that in mind. But it's a derivative of the underlying. Its value is derived from an underlying asset. So we're going to look at how options fall in that category. We're going to look at the advantages, flexibility, risk, flexibility and limited risk, the disadvantages, time decay, complexity, and we're going to look at how does it compare to buying stock, and a little bit of options recap. Okay. Understanding financial derivatives, definition and purpose of derivatives. They are contracts. You are trading a contract. So when you hear, when you think about what's happening here, you have buyers and sellers of the contract. The contract has the ability to control the underlying asset, but we are trading contracts. That's important because we want to understand the why. I don't buy options because I intend to buy the stock. In fact, I can't think of a single time where I exercised the option to buy the stock. If you do that, you're paying more to buy the stock, right? Today I pay $5 for a call option on a stock that's at 52, and it's a $50 strike. If I exercise that, that means I'm buying the stock for 55. Take the call price, add it to the stock price, 55, right? You're better off buying the stock for 52. If I'm going to own a stock, I'm going to sell an option. Instead of buying it, I can sell an option for $50. And if it expires out of the money, I keep the premium. I made money. I was willing to buy the stock. If the stock does get put to me, what can I do? Steven knows. Sell covered calls. If the stock gets called out, what can I do? Sell another put to get back in. This is an income strategy. This is not as much speculative. I'm buying for 3, 4, 8 days of momentum, but this is more of an income. So you can see that the flexibility that we have with these derivatives, these contracts, is vast. They are dynamic tools that derive their value from the performance of the underlying, influencing financial market dynamics. So we have to keep our eye on other elements such as time and volatility, but it is based on the underlying option. So let's give a quick overview of options. Options are a very distinct derivative type. What would be another derivative? Futures. Futures. Right? So when we look at the market on the morning before the market opens and we're like, oh, the futures are up. The futures trade 24 hours a day, 5 days a week. So before the market opens, we can look at them and say, oh, look, the futures overnight, I can see right now. I could go look at the futures and see, are we up or down, right? And then around 8 a.m., the pre-market opens and we start to see a little correlation. And then when the market opens, everyone's paying more attention to the stock. And then the futures tend to match the stock or the stock market. And then, right, but that's a derivative. You can trade those. Those are contracts. They don't trade like options. They're different types of derivatives, but they are derivatives. It's a distinct derivative type that gives the holder, meaning the buyer, the right, not the obligation, to buy or sell a specific asset. I have the right to buy, call option, or I have the right to sell, put option. This flexibility gives traders the ability to navigate market conditions within a predetermined price and a specific time frame. That's all we need. Sometimes those are different time frames and different conditions, and they might dictate different strategies. But overall, we have a specific price range we're looking at and a specific time frame that we're looking at. Understanding options involves recognizing their pivotal role, shaping strategic positions, providing unique avenues for financial maneuvering, selling covered calls, right? Things like that, turning things into spreads, trading spreads, unwinding spreads. A lot of different types of flexibility within the realm of options. Options, it's a funny thing, because I think always learning. Now, there's always something about options where I'm like, oh my gosh, I didn't realize, right? Where I'm like, you know what? I wonder, how this is going to react if this happens. I mean, it's as you scratch the surface and you realize the abilities you have, especially when you're trading with a model that helps. Amazing, amazing, amazing. All right, let's keep going. Why? Why do I love them? Flexibility. Flexibility is the biggest thing. If I think the market's going up strongly, I can trade strongly with options. If I think it's going up a little bit, all of a sudden the direction's less clear. What should I do? Let's add time to the mix for sure. If it's going up a little bit, things will take longer, slower, not going up as much. I'm going to hedge that. If things are going sideways, if you're trading stock and the market's going sideways, what are you doing? Nothing. You're just watching things. You're not sad. It's not like it's going down, but nothing's happening. You're not making money. You're not losing money. You're just sitting there. What if I could sell premiums against my, things going sideways and say, hey, you know what? I'm going to sell something out of the money. As long as it doesn't break out, I'm going to be fine. If it does break out, I could try to adjust. I can adjust myself to it. So flexibility, whatever the condition is, I can build a trade to match it. Potential for high returns with the ability to manage risk. We've seen that a little bit, right? I mean, you can get 150%, 200% on an option. You're not risking any more. You can control. It always makes me laugh when people talk about how risky options are. Options are only as risky as you let them be. You control the risk. If you do it right, you define it, you control it. And yes, huge potential for returns. We've seen a couple instances where we're like, this could be a 3-to-1, 4-to-1. And you can get them quickly. Another advantage lies in the versatility of options. We can trade, whether it's a bullish market, neutral market, bearish market. There's nothing else that allows me to customize my approach to the market as much as options do, period. They sound great. What are the disadvantages? Time. Exactly what I told you. The time is always ticking. You buy an option, it's like you pulled an ice cube out of the freezer. Starts melting. It's going to keep melting. That's it. Now, the other problem is you're walking towards a heat source, and the closer you get, the faster it melts. It's not going to survive that. So time is working against you, and time increases your time decay decreases at an increasing rate. The closer you get, the more you lose. The second factor that we really, and this is, I can't stress enough, it's harder. Obviously, there's increased complexity. We have buyers and sellers. We have calls and puts. And if we combine them, we have credit spreads and debit spreads. And there's a lot of different ways things can go. And again, I'll tell you right now, I felt like I had a pretty good sense of options back in 2006 when I can't believe it's been almost 18 years. But back in 2006, when I got my hands on this platform, and it just accelerated everything, because I could, what if I could be like, oh, well, what does this look like before what this looks like? Risk profile is going to be a concept you're going to really want to embrace. The risk profile of a trade that shows how do we gain, how do we lose, how does time work, etc. Every options trade has a risk profile. So, all right, let's get going. Basics of options. Calls and puts. That's the basics. Calls, puts. I will tell you this. There are some elements of options that are just not intuitive. You can't just sit and think about it and be like, oh yeah, that makes sense. You're gonna have to memorize it. That's just I tried. I remember back. Now I'm going even further back than 18 years. But when I first got my Series 7 and I had to take the broker exam, it wasn't FINRA at the time. It was what did we used to call it? What did FINRA used to be? Can't even remember now. NASD, the NASD, National Association of Security Dealers. Okay, so when I took that test, I mean, it was hard. You just have to memorize it. You just have to say it over and over, wrap your mind around it. Sandy, I like your perspective. She said, I really love the intellectual challenge of it. Yes. So calls, puts. What do we use calls for? To profit from upward movement. Remember that this is perspective of a buyer. Buying calls, bullish. Buying puts, bearish. It can either provide a safeguard against falling prices. That's how options behave as a hedge, which we do, right? We hedge. We have a very specific hedge signal that gets generated by the VIX. That's buying puts. Puts in that regard is not speculative. Can be, but tends to be more defensive and a hedge, or to profit from market downturns. So market's going up. What do we think? Buy calls. Market's going down. What do we think? Buy puts. Now remember what I said. If we're ever going to reverse things, it's just an opposite. If you're bullish and you're buying calls, what would you do with puts to be bullish? Sell puts. And if you're bearish, you would sell calls. So it reverses things. And it's like when you start trying to think of that too early, you get twisted around. I know because I've been there. You're going to be like, what? Oh, yeah. Okay. So just keep that in mind. Right now, buyers, call options up, put options down. Right? What do I have? I have rights. The right to do what? To call out the stock. That would mean force somebody to sell it to you. You're calling it out. You have the right to buy the stock. Calling it out is implementing that right. So what is a put option? I have the right to put it to you or to somebody. I'm putting it to somebody else. I'm forcing them to sell, right? And remember, I'm forcing them because they have an obligation. Buyers have rights. Sellers have obligations. Super important to recognize the difference, because as long as you have an option out there, your obligation holds. Okay, so that's calls and puts. Pricing, intrinsic value versus extrinsic value. Every contract is going to be made up of one or both of these. Typically, if it's well, not typically. If it's in the money, it has both intrinsic value and extrinsic value. So intrinsic value signifies the real-time value of an option. If I have a call option to buy a stock at 50 and it's at 52, I have $2 of intrinsic value. If I paid $5 for that option, what's the other 3? 5 minus 2. There's 2 of intrinsic. What's the extrinsic or the time value? $3. That's how much I'm paying in time for that option. Now, if I had a $52 stock, I could also buy a $55 call. That would be out of the money. Out of the money means there's no intrinsic value. Stock's at 52. You have the right to buy it at 55. What's that worth? Nothing. It's at 52. If you wanted to buy it, you'd buy it at 52. You're not going to pay 55. What do you have then? You have time. Because if it goes from 52 to 58, then that option has $3 of intrinsic value. So if I only paid $1.50 for that option, I'd made double my money. We have to understand where these values are coming from. You're not going to need to sit and calculate it, but you just need to have a sense of where it comes from. So intrinsic value, extrinsic value. What do you have now? And what's the rest? Basically meaning time. What are the factors that influence options prices, the Greeks. The factors are delta, gamma, theta, vega. What does that mean? Price, that's both delta and gamma. Price, time, volatility. Price, time, volatility. That is what we're looking for. These factors play a crucial role in determining option premiums, guiding us in effective risk management, strategic decision making. Get access to a pricing model. Steven said, I have to learn how to analyze the trade to get 200 to 400% wins. I mean, it's really not. I don't know that you've had, if you look at what the market's done. So let's go look at this. Let's go pull up. Let's pull it up. Okay, so here I am. We had a city trade. If you had kept your city trade, I kept moving my city trade. The city trade did get an execution. Did anybody trade city? We had kind of looked at that one. It was rocketing at one point today. Still profitable at the end of the day. If you're in that one, but analyze. So here you can see. Let me get my drawing tools. This is so very important. I think sometimes the concept foundation has become a platitude. Oh, you have to have good foundation, a foundation. But for me, one of the metaphors I use for trading is building a house. And the reason I use that is because everybody builds a different house. Some people love big houses. Some people love nice, easy to clean houses. Some people love, 2 stories, 3. So right, everyone's house is different, colors, size, shape, decor, everything about it. But we all start with the same beginning point. And that's that slab. When I think foundation, I think that slab. Is it deep? Is it strong cement? I want to build on that. And I can tell you, having at this point worked with more than 10,000 traders over the last 20 years, a lot of people build their house on sand, and it's inevitable. If they do it during a strong market, they might last a little while, see some profits, and then, yeah. So, same thing with options. I see way too many traders that start to do things, and I'm like, you don't even understand what you're doing. How can you possibly expect yourself to maintain confidence and discipline if this trade might do something that you're just not prepared or expected to see? I don't see how we can expect that of ourselves. So it's very important that we get this. Now, let's go ahead and key in on this pricing model then. So these are the options. This here, so you can see I have add simulated trades. What does that mean? That means that if you look at the trade tab, what do I have? I have an options chain. I have a stock quote here. Here's my stock quote. And then I have this options chain, and the options chain is everything else. I'm on Citigroup. Citi has a lot of different options. These are all my expirations. March 8th, 3 days. March 15th, 10 days. March 22nd, 17 days. March 28th, 23 days. Oh, why only 23? And then why is it 31? It went from 6 to 8. Why? Good Friday. There is no Friday, the 29th, because it's Good Friday. You can see that these are purple. Why are these purple? Because they're weeklies. A weekly is non-standard. This is not purple. This is black. Black means standard. 3rd Friday, March 15th. This is the 2nd Friday, March 8th. We already had the 1st Friday, March 1st. This is the 4th. This is the 5th. And then what? Then we have the 1st, 2nd, and what do you know? Here's the 3rd. The 3rd one is black. Those are standard. Anytime an option is not the 3rd Friday of the month, not 100 shares, it's going to be purple. Usually purple means quarterlies or weeklies. So just something to recognize. Now, when I pop open this options chain here, now sometimes they'll show one side or the other. This one shows both. So I have calls on the left, puts on the right, expiration and strike price down the middle. 4 is not very many. I like to see more options. I might put it to 12. You can see all that does is show me more of what's available. If you go to all, it will overwhelm you because there's a lot of different options and we don't need all those. So I go to 12. If a question pops up, spit it at me. I'm keeping my eye on the chat. I know I'm just kind of blazing through this. Here's the deal. Any platform is going to be similar to this. You're just having to, if yours isn't this platform, then you just have to kind of correlate it to yours. But every platform has their options chain and their quotes where they show you what does this look like. So if you look here now, I can change this layout. So I can look at the Greeks. That's what a lot of people like. So they have their deltas, their gammas, their thetas. I like volume and open interest. This is for liquidity purposes to make sure, of course, Citigroup is going to. Look how many thousands and tens of thousands of contracts. And then I have bid and ask right here. These are my prices. If you're a buyer, you're looking at the ask price. If you're a seller, you're looking at the bid price. If you're ever not certain, just remember, whatever one you want, you get the other one. So if you're a buyer, you want 68, you get 71. If you're a seller, you want 71, you get 68. Pretty easy to get that. What am I looking for? I'm looking for this to be as small as possible, that spread. That's efficiency. That's why we look at high liquidity options. We want there to be millions of shares trading. We want there to be thousands and tens of thousands of contracts. Could this support every single one of us buying 20 contracts tomorrow? No problem. Yep. Not even a blink. That easy. Right? Not all options are created equally. I can tell you that. Okay. Now, this is the trade tab. If I wanted to trade, I would just come in here. Then I go to the Analyze tab, and I'm in the Add Simulated Trades, and you'll notice it's exactly the same. I have all the same things, all the same options. I can also change the strategy from single to vertical. This is vertical spreads. This is calendar spreads. This is diagonals. I have all these ways that I can help build trades the right way. We're starting with single. We're buyers. That's it. First, we're buyers. We're focusing on these ask columns. Then we come sellers. We focus on the bid columns. And then, right, we're building blocks. Now, what does it add simulated trade mean? So if you notice, I actually have trades. These are live trades. I can't change this. You can see it's in white. I can't change that. But if I wanted to say, hey, what would a new trade look like? Well, I can come in here and I can say, let's look at an at the money call 1 month out. So I come here 31 days. I come at the money. We're at 56.26. Remember, here are my strike prices. What does at the money mean? The closest strike to the current. Closest. 56.26 comes down here. 56 is the closest. So if I were going to buy that call option, here's the calls. As a buyer, I look at the ask price. That brings me down, and that's my price, $2. And if I want to see what would it look like to simulate that, I just click on it. Boop, one time. Don't double click or you'll have extras down here. But you can see this is in green. That's a buyer. If I went in red, boop, that's in red. You can see buy, sell. I don't want this one. Get rid of it. Great. This is a simulated trade. So I could say, what if I did 5 of these, 4 of these? And I can see what would this trade look like now from here. This is different than the ones I already have. The ones I already have are making money. This is a new trade. So this would give me the ability to come in, set my stop, set my target. That's what we're going to be doing. Maybe a little bit on Thursday, definitely next Tuesday is coming in and actually building trades. Build 2 or 3 every time on the application session. So very, very important to just kind of get comfortable navigating through here. These are real trades. This is a simulated trade. I could get rid of it. I could change the strike. I could say, what if I could buy this for $1.75? I don't think I would be able to unless the stock drops, but I could say, what would it take? Let's do that. So let's say I want to buy this for $1.50. Boom, 150. What would the stock have to do for me to be able to buy that for 150? This red hash mark. So if you look up here at this risk profile, what do we have? We have gains and losses over here on your y-axis, and you can see there's the 0, which means this is break even. And you can notice that I have 2 little red hash marks here. Those are the areas where we cross break even. So those are my break even points. And you might think, Scott, why is there a purple line and a green line? Well, if you look down here in this bottom left corner, purple is, might maybe not see it very well, but purple is 3.5 today. Green is 4.5 expiration. So that's what's happening, right? At expiration, in order for us to break even, this thing has to go all the way up to 57.5. Right now, it's barely above 56. If we wanted to buy these options for $1.50, we would need the stock to pull back to about right here around 55.50. I don't think it's going to pull back there. But if you did, you might say, hey, let's wait on this. But this is a what if. What if, what if, what if? I can what if time. I can say, what if I paid $2 for these options now? And let's say that I stayed in this trade for 1 week. So I come out and I go to the 12th. And you'll notice what? Everything is, if it stays where it is, I'm losing money. Why? Because it's showing me time. In fact, if you notice, it's showing me time here. I know exactly. If I do 5 contracts, I'm losing approximately $16 per day. That's what this theta value is. When you look at a theta on an options chain, it doesn't help you. You're like, oh, it's minus 0.06. What the hell does that even mean to me? Here, when I have 5 contracts at $2 a piece, my theta is minus 16.25. That means I'm losing $16.25 every day I hold this trade. It's my carrying cost, my theta. Okay, that's meaningful information. We can do something with that information. That's going to help inform decisions, right? So risk profile, that's this entire picture. I can see the totality of this trade, right? I can see that if it's below 56 at expiration, it's at max loss. I can see that max loss is around $1,000. It has unlimited upside potential. This will keep going up forever. Don't believe me? Let me show you. Keeps going up, keeps going up, keeps going up, keeps going up. Hey, if this stock goes up to 100, from 56 to 100, these options are going to make $21,000. Amazing. Is that going to happen? Of course not. I'm just saying we could quantify it. If someone has a what if it goes, I can answer that question. What if the stock goes to $1,000? We would make $471,000 on these. What if? Now, is that a realistic what if that I should consider? Probably not. Right? So, all right. Pricing model. So if you have it, play with it. That's the only way you're going to get comfortable. Play with it. Add a trade, take a trade off. Paper trade, paper trade, paper trade. In the beginning, Sandy made a comment today in Discord, which is that it feels real, which is perfect. That's trading to get experience. But you should also trade to get acclimated. Trade an option, just buy it. I don't care why, right? Just there's going to be some trades you're just practicing, like, hey, let's buy 10 calls and just see what happens. Let's buy 10 puts. Let's do this. It's like a playground where you can't get hurt. So go play. Play with the model. See your what ifs. Get comfortable with it. Oh, sorry. Yeah, here's the probability analysis. We're not even going to get to that yet. That's a whole nother conversation. Okay, back to the slides. That's it for today. Hopefully you have a little better sense of calls and puts and intrinsic and extrinsic. And what do I need? I need tools. If you're going to do this, don't build your house with a hammer and a saw and a screwdriver. Build your house with a air gun, with a nail gun, and with power saws and with drills. And could we build a house with that equipment? Yeah. Do you want to? No, I want power tools. I want as many power tools as I can have. If I have the right tools, I can be more efficient, period. So make sure if you're going to do this that you go find those tools. Whatever platform you're on, call them tomorrow. If you're on Charles Schwab, go download Thinkorswim, go to YouTube, start watching videos, watch what we do. I mean, look, just get comfortable with the platform. If you're on something other than, call them, ask them, what do you have for option pricing models? I want to trade options. I want to know what you have. And start to get acclimated with that. So recap. What did we do today? Fundamental concepts of derivatives. This is based on the stock. The stock informs us. The option is just the vehicle. Hopefully you have a better sense of why we do it, what it's going to give you. And I hope you're motivated to come bet. But if not, okay, right? You got to get in where you fit in. So that's important. We talked a little bit about calls and puts. What are we expecting? Up or down? What do we have? Rights. What does it enable us to do? Buy or sell the stock to somebody else who is obligated to do so, along with understanding option pricing factors, price, time, and volatility. Next session, we're gonna dive into the key concepts, terminology. We're gonna explore basic strategies in more detail. We're gonna be on the platform, and then Tuesday is a all platform day. We will hit the platform on Thursday. We will get into that in more detail, but Thursday, all platform day. Awesome. It's good to see everybody. Anyone have any questions? I mean, I've kind of left it open along the way, so I'm not really expecting anything. I hope thank you, Stephen. I hope it was enjoyable. I hope you guys are excited. I love options. I love options. Can't wait to talk about them more. So it's good to see you guys. Have a great rest of your night. I'll see you tomorrow morning, 9:15 a.m. Eastern time. And as always, happy trading.